Let's get started. Welcome everyone to our options boot camp drill number 3. This is our third week um, of going through the basics of options and options trading. And The agenda that I want to cover today is we'll do a quick recap of what we've already covered in last 2 sessions, and then we will jump on to something called moneyness of an option contract, right? What are these abbreviations? ITM, OTM, ATM, if you have started trading options. And my assumption is that many of you have started trading. That was the homework. So you should have started trading. Uh, and then you might have come across these terms, right? So we will decipher, get into the details of what these means. And lastly, I want to cover a very important process of, how this whole exercise, option exercise and assignment process works. So if we are just new to option trading, this is always a puzzling thing, a very sometimes scary as well, to talk about assignment and margin calls and things like that. So we'll do a deep dive into that process. Okay. All right. So before we start, I am not an investment advisor, nor I'm a financial consultant, nor I'm a tax consultant. Everything what I'm sharing is what I've learned, and just want to share my learnings and just to educate others. I was exactly in the same boat like you are a few years ago, and I learned the hard way, and I just want to make it give back to this community by sharing what I've learned. So don't take it as an investment advice and start trading based on solely what you hear. Take it as a learning, and then create your own trades. All right, so let's start with our first agenda, which is quick recap of our previous sessions. So till now, we've covered the very basics of any options. What is an option contract, right? What are the main elements of option contract? What do you mean by an assignment and exercise in an option contract? Is it a contract that I can back out? How does it work? We also took some real life examples of an option contract. Then we looked at very two basic building blocks of an option contract, which is call option and a put option. Right? Any complex strategy, maybe Batman strategy or a back ratio spread or any other scary names that you might have heard, all those complex option strategies can be broken down into two basic components, call and put. Now, these are like electrons and protons of option atoms. Every object in this world can be broken down into atoms and then electrons and protons. Similarly, every complex option trading strategy can be broken into call and put. So we'll look into the details of that. And then finally, we also looked at what are those two newbie option trading strategies, cash secured put and covered call. So now it's a time to move on. And before we move on, there's some pop quiz. If you thought that, you can just come here, not do the homework and won't have to deal with the quiz, you were wrong. I want to check how my students are doing. Oh, thank God I'm not in teaching profession. I've been in software industry. All right, so let's start with the first one. I hope you all should be able to see the poll, and you got 40 seconds. Buying a put is equivalent to buying an insurance. What do you think? True, false? Okay, we got close to 15 participants. I'm expecting a lot more people to participate. That's the only way we can reinforce what we have learned. Before we pile on, a lot more additional concepts, it's important that we get very clear about some of these basics. That is why this is boot camp and it's not just, a normal lecture. All right, I'm ending the poll now. So most of you have got it right. Buying a put is indeed equivalent to buying an insurance. Okay. All right, let me get back to the next one. All right, the next question is in front of you. Newbie option traders should stay away from which of the following option strategy? Short call, long call. We talked about, the P&L diagrams of all of them. Cash secured put, long put, or covered call. You got to pick only one choice. So you get 45 seconds to answer it, 10 more seconds to go. All right, let me stop the polling. Yes, most of you, I think 50% got it right. The short call is what a newbie option trader should stay away from, because in a short call, in theory you have unlimited amount of risk, because the stock can go 100, 200. Amazon is at 3,000. Berkshire Hathaway Class A shares is at 300,000. In theory, it can go to unlimited. So that exposes us to huge amount of losses. So short call is the correct answer. I see long put. Long put, we just talked about in a previous question. It is equivalent to buying an insurance. So you will only lose the amount of premium that you have paid in case of a long put. Long call is the same thing. It means you are buying a call, you paid an initial premium. So your maximum loss is limited to the amount of premium that you have paid. It's a short call, which I would advise if you're just new to option trading, stay away from. It might look attractive, but you really don't have to expose yourself into that trade unless you become a little more experienced. All right, let's move on to the next one. Option seller has the right to exercise the option. We talked about exercise and assignment and who's got what. So the question is, does option seller has a right to exercise the option? Is it true or is it false? Right, 15 more seconds. Most of you got it right. 93% of you got it right. Option seller. If you are an option seller, you don't have any rights. Only thing you have are the obligations. Option buyer has the right. And that is why the buyer has paid a premium to earn that right. As an option seller, we receive the money. We receive the money, and for that premium that we have received, we have to perform some obligations. So false is the correct answer. All right, let's move on to the next one. Is it mandatory for option buyer to exercise his or her option contract? We just now talked about who can exercise. It's an option buyer, but is it mandatory? A few more seconds. All right, 100% of you got it right. This is false. If you're an option buyer, you have a right to exercise. It's not mandatory. You can choose not to exercise. So good job out there from everyone. Let's move on to the next one. Which of the following strategy has theoretically unlimited gain potential? I missed the L. But I think you get the point. Which one has got unlimited gain potential? Potential. I need a spell checker in Zoom. Okay, we got 15 more seconds to go. All right, time's up. 77% is long call, 15% is short call, 8% long put. The correct answer is the majority. Long call has got, in theory, it has got unlimited gain potential. Because when you buy a call, you are giving yourself a right to buy the stock at the strike price. And stock can go to infinity. You know, doesn't matter. You bought a long call at a strike price of 50, and at expiration stock is at 70. It could be at 80. It could be a 1,000. It could be at infinity. So in theory, there is a unlimited gain potential on a long call. We are not talking about the merits of which is the right thing to do. Lottery has got unlimited, almost unlimited gain potential, but I don't suggest everyone go out and buy lottery. Right? So just from as an academic exercise, it does have unlimited potential. Okay, the next one. Believe me, we'll be ending this soon. So the torture will end soon, but you have to go through this. I just want to make sure that the concepts are refreshed. Yeah, if you don't like this, do put me in a chat, say, this is torture, we don't like it. Let's jump on to the next topic. A covered call can be sold without owning the shares. We are talking about covered call. I have 15 more seconds. All right, time's up. Most of you got it right. When the name itself suggests that it is a covered call, means the call that you have sold is covered by the amount of shares that you hold in your portfolio. So you cannot sell a covered call without owning the shares in your portfolio. If you sell a call without owning the shares, that will be the short call, which we talked in the first question. I don't suggest new option traders doing that. Okay, let's look at the next one. All right, this is for those out math geeks. Little bit of a math calculations. Calculators are allowed in this test. So you can whip out your calculators. You sold a cash secured put at a strike price of 35 and collected a premium of $2. If you were assigned this contract, the cost basis of owning the shares will be what? I have 5 more seconds. You didn't expect math here, did you? All right, 85% of you got it right. That it is $33. The reason is when you sell a cash secured put, you already collected a $2 premium upfront. So even if you're assigned the shares, the ownership, the cost basis of owning those shares is 35, and then you reduce the $2 premium that you received. So it is $33 is your cost basis of owning those shares. Okay, 3 more to go. Now, a little more math. I bought a call for XYZ stock at a strike price of 50. For this, I paid a premium of $3.50. What is the break-even point for me on this trade? Just to refresh, break-even point is the price at which the stock is, the trade overall is neither profitable nor loss for me. Okay, 15 more seconds. If you have you want to change your answer, you could. Okay, the time's up. So 85% of you said $53.50. 15% of a respondent says it's $3.50. So in this case, the break-even point for me would be $53.50 because the stock has to rise beyond $53.50 for the overall trade for me to become profitable. The maximum loss in this trade could be $3.50. But if the stock is below $53.5, overall trade is still not profitable for me. I only make money if a stock goes beyond 53.5. That is why it is $53.50 is our break-even point. All right, the next one. I sold a put on XYZ at a strike price of 50 and collected $5 premium. By how much can the stock change before it starts to challenge my overall position? Yeah, I sold it, so it's my position. Can it rise by 5% before it's challenged? Or it can fall, by 10% before it starts to hurt me? Or can it rise by 10% before it starts to hurt me? Lastly, can it fall by 5% before it starts to hurt me? Means if it becomes 6%, it's a bad thing. I do see some questions on the chat, so we will take up Q&A at the end. Ross, so yeah, hang on to those questions. All right, let me finish this. Looks like this was a little more challenging. Fewer people have responded to this, but 73% of you got it right that it can fall by 10% before it starts to challenge me. The rest have got mentioned the answer can rise by 10%. So if the stock rise or if the stock stays where it is, it's anyway profitable position for me because I sold a put. So either stock staying where it is or even if it's rising by penny, it's never going to challenge me because this is a bullish trade, stock going higher. It's always a profitable position for me. Stock going lower could cause concerns to me, but it won't cause any concerns to me until it has fallen by more than $5, which is 10% of its value. So most of you got it right. Okay, the last one. And this is to check. Homework check. Please pick one or more as applicable. I have sold a cash secured put. I've sold a covered call. I bought a put or a call. Or I'm completely newbie here and I never done any option contract. A few more seconds. 5 more seconds. And I promise this is the last question. Okay. Most of you have done. cash secured put, and many of you have also bought a put or a call. 25% of you haven't done anything. So, but if you have attended last 2 sessions, we need to talk after the session. You haven't done your homework yet. But if it's the first time you're coming here, I can excuse you for not doing any option trade. Really, I mean, your learning can only continue if you dip your feet with the very basic option trading strategy. Otherwise, we will move along. We'll move on, and then you'll be wondering, what was that initial one? How do I sell a put or how do I sell a call? All right. There you go. All right. I see a couple of people says, I want to pick more than one option. Oh, my bad. I thought when I set up a poll, this was set up as a multiple choice question that you should have been allowed to pick up more than one. My mistake. So we will end this session here. Ramesh asks, who scored 100%? What was the highest? I don't get to see any names around here, so I don't know who was answering what. Okay, so let's get back to our session. I hope you enjoyed it. It reinforced what we have learned. And for those 25% who have not done any trade, please do the very basic beginner option trading strategy, right? If you're interested in buying a stock, maybe sell a cash secured put. Or if you have been holding stock in your accounts for years or 2 years, I haven't done anything, maybe sell a covered call, reduce your cost basis. You have nothing to lose over there. Stock will be called away only at the price at which you pick up, but you get paid for waiting. So go ahead and try some of those basics. All right, so plan for today is we're going to talk about moneyness of option contract. That's where the whole in the money, out of money, at the money comes in. Then we'll spend some time. If there are any questions on that particular section, I'll address it. So during the session, I won't be looking at the chat. I just want to go through it first, and then I'll come to Q&A. Then we'll talk about the whole option exploration assignment process and take a Q&A on that. All right. Cool. Any questions before I jump into this session? All right. You're welcome, Ramesh. All right, so let's get into the moneyness of an option contract. So we're going to talk about what is moneyness. What's this term mean? We look at moneyness for both put options as well as call option. And then we will see from the perspective of option buyer and seller, what's in which state, who gains. And finally, we conclude with the takeaways. All right, so moneyness. So state of moneyness of an option contract will tell us if the option contract is profitable. And in this case, don't consider the premium that has been paid. And in subsequent slides, I'll show why, it is without considering the premium. So if you bought an option contract and if it is making money for you, then it means it is in the money. So it is always viewed from the perspective of buyer of option contract. That doesn't mean that you need to be always buyer. But when you talk about moneyness, we have to set a context for what's the context? Am I talking about buyer or a seller? Right? So because an option contract can only have one state. Either it can be in the money or it can be out of money. So we need to now pick up from which user context are we talking about. And it is talked about from the context of option buyer. Means how does this option contract currently impacts the buyer of the contract, right? If it is profitable for the buyer of an option contract, it is called in the money, right? It is making money for the buyer of the option contract. That is why the option contract is in the money. Or if it is not making money, it is losing proposition for whoever has bought that contract, then it is called out of money. There is no value in this option contract. This is worthless. I don't want to deal with it. right? So that's out of money. But if it is at break even, it's neither making profit nor losing money for the buyer of the option contract. It is called at the money. Now remember, I mentioned it that it does not take into account the option premium. And we will see in subsequent slides that it does have a lot of impact. But the way an option contract is defined, in the money, out of money, at the money, is if it is making money for option buyer, or if it is a losing proposition, or if it is break even for option buyer. All right, so let's look at put option contract and how the various moneyness states move. Right? It is in the money if the stock price is less than the strike price of the option contract. Spend a few seconds to go back to our boot camp drill number 1, where we talked about put option contract. Now, like I said, it is viewed from the perspective of option buyer. So if someone is buying an option contract at a strike price of 50, if the stock is at 45, that person can still exercise the contract to sell the stock at 50. So it's a profitable situation for a buyer. So as long as the stock price stays less than the strike price, the option buyer, he did the right thing by buying the put option contract. Right? Now the put option contract is working for him. But if the stock price is beyond the strike price, if the stock is trading at 51, then it's not a good situation for the option buyer, right? That contract is of no value to him, because the contract allows the put option buyer to sell the stock at 50. Why would he do that if he can sell it in the market at 51? Because it is being trading in market at 51. Right? So the option contract has got no meaning, is not making any money for that a buyer. So it is out of money. Now, if the stock price is exactly at the strike price, then it is at money. So this is how you would see if the stock price is higher than the strike price. So this is your strike price. If stock price is anywhere over here, it's called option contract is called out of money. If it is less, then it is called in the money. Now, if this is a P&L diagram or profit and loss diagram we reviewed in drill number 1 for a put option contract, right? Someone who has bought a put option, we're looking at a long put. Long put means the benefit if the stock falls. So the strike is at 27. And if the stock stays at 27, then the option contract is at the money. If a stock goes beyond 27, like we talked about, then it is out of money. And if the stock is below 27, it is in the money. Means whoever bought this contract did the right thing. The contract is now working for the put option buyer. Now, the reason I want to share this is this does not consider the premium that has been paid. While the option contract is still in the money, the overall position, considering the premium paid, is still not making money for the put option buyer unless the stock falls below $25 and $50, below the amount of premium that has been paid. So even if the stock is, the option contract is in the money, say stock is at $26 stock price. So it is in the money, but it's not really yet, the overall position is not really making any profits. So when we are talking about ITM, OTM, We just look at the relationship between the strike price and the stock price. Don't consider the premium that's being paid. Okay. All right, let's look at the call option contract. Now, for the call option contract, it is okay. I see that odd is lost 6:32. That means a minute ago. Now looks like I'm back. Yeah. So I guess, did you lose me here? Okay, all right. So yes. So the call option contract is in the money if the stock price is higher than strike price. We talked about it in drill 2. What is a call option contract? If the call option contract gives a right to the buyer of the option contract to call the shares or to get the shares at the strike price. Say an example, stock XYZ. I am a call option buyer at a strike price of 50. Now the stock is trading at 53 in the market. I will for sure exercise my option contract so that I can get the shares at 50 and I will sell those shares in the market at 53. That's a profitable situation for me. And it is going to be profitable as long as the stock stays above 50 because I have a right to get the stock at 50. If a stock at 60, stock is at 51, I can still use my call option contract to get the stock at 50 and I'll sell it in the market at higher than 50. So it is in the money if the stock price is higher than the strike price. On the other hand, it is out of money if the stock price is less than the strike price. Right? I have a long call option. I bought a call option which gives me right to get the shares at 50. If those shares are trading in market at 45, why would I ever use my call option contract? I'm not crazy to buy it at 50. I would rather, if I want the shares, I'll pick it up at 45 from the market, right? So that call option contract is useless for me. It is out of money for me. It's not making any money for me. If the stock price fall below the strike price, then the call option contract doesn't make any money. It's a losing proposition. But if the stock price and the strike price stays the same, this is called at the money, right? Not profit, no loss. So this is how you'll see if the strike price is here, if the stock price is here, it's at the money. If a stock price is higher, it's in the money. If a stock price is less than the strike price, it is out of money. Let's look at from a P&L perspective, right? Now, when we talk about profit and loss, including premium, right? Now, what you see in a green line here on the axis, this is in the money. because the strike price is 29. So I got a message, my internet connection is unstable. Let me do a quick check. You all able to hear me and see the deck? Okay. I have to see if my kids are streaming some movies or playing some games. All right, so if the stock falls below the strike price, it is out of money. Now, take a note here. If you bought a call option, if you're a long call, even if the option is in the money, say it is 29 and a half, $29.50, overall, it is still not profitable. So that's why I just wanted to put this up front. It doesn't mean that if it is option contract is in the money, it's immediately start to make money for you. The definitions or the way it's called in the money doesn't take into account the premium that has been paid. All right, so this things that we should look at is the moneyness of option contract is not constant, right? This is the relationship between the stock price and the strike price. The strike price of the option contract stays the same throughout the expiration period of that option contract. But the stock price will change, right? It changes every minute. So the moneyness, the state is not constant. It changes whenever the stock price changes. Right? Something which is just in the money could immediately turn out to be out of money because the stock price moved. Say you bought a put and at 50 strike price, stock is at 51. It is out of money for you. But stock could go back to 49, it has become in the money. Or it could be the other way around. So if today your positions are in the money, your stock, your option contract is in the money, and if you're a buyer of the contract, don't start to celebrate too soon because it could turn out to be out of money tomorrow. Right? It will change. It keeps on changing as long as the option contract is still valid. It could change anytime. If an option contract is gone far in the money, that's what generally we'll call it deep ITM or deep OTM. In that case, stock has to make much bigger moves to switch from one state of moneyness to another one. But in theory, it could. So it could change because the stock prices could change, right? Now let's look at from an option buyer and option seller perspective. So till now we've been talking about moneyness is defined from option buyer perspective. And we know that if it is making money, it is ITM for option buyer. But for an option seller, that's not a good situation because option seller is on the other side of the contract. If option buyer is making money from that contract, it means the option seller is not making money from the contract. So if I'm an option seller and if the contract is in the money, I want to emphasize again, the in the money definition is from a perspective of option buyer. So it is in the money. As an option seller, it's not a good thing for me. As an option seller, it's a great thing if it is out of money. But for an option buyer, it's not such a good thing if it is out of money. So what I do is mostly option selling, and I would pray that all the options that I've sold should expire out of money because that's when I will make money. And if someone is option buyer, they would pray that the options should expire in the money because that's how they can make money. So little difference in terms of who is happy based on the moneyness state. Okay. All right, let's talk about how the moneyness and expiration are related. So if an option is in the money near expiration, it will be exercised by option buyer. That's how, as an option buyer, I will be able to capture the profits, right? Let's get back to our example of long call option. I bought a call option at $50 strike price for stock XYZ. Stock XYZ is now in the market. It is trading at 53. How do I get those $3? I have to exercise my option because now it is in the money for me. So if on expiration, the option contract is in the money, it will be exercised by option buyers. And if you are one of that person who has sold that contract, you will be assigned that contract, right? So keep an eye when you're getting closer to expiration, what's the moneyness state of those contracts that you have sold? Or if you have bought, what's the moneyness state? Right? Because through this process of exercise is what the option buyer will be able to capture the profits. Okay. Now, if it is out of money, those will expire worthless. And there will not be any transaction from either the buyer of the option contract and hence from the seller of the option contract. So buyer has got a right to exercise. And if only the buyer will exercise the right, then only the seller will be assigned. Seller don't have any right. So if buyer doesn't want to exercise, fine, seller won't do anything. Right? So it will expire worthless. That's what we said, that the contract expired worthless. It was out of money at expiration, no transaction. Whereas if it is in the money, there will be transaction happening in your account if you are option seller or even if you are an option buyer. But if it expire out of money, there's no transaction. All right, so takeaways. Moneyness is always viewed from the perspective of option buyer, even though you are an option seller. I am option seller. When I'm talking about in the money or out of money, I will still talk as if it is from a perspective of option buyer, right? Option buyers would want option to stay in the money at expiration so that they can capture the whole profit. They can exercise it sooner also. We'll talk about it. But right now we're only talking about at expiration. Option sellers want options to stay out of money because that's when it will expire worthless, zero transactions happening. And as an option seller, whatever premium that I have got when I opened up or when I sold that option, I get to retain that. All right, so that brings us to the end of this section. Let me look at the chat and see any of the questions. Oh, Shannon mentioned it is a little wobbly. Is it still wobbly or now is it okay? Okay, cool. Can a buyer accept before expiry? Yes, we will talk about it. I think Fred already mentioned American style, European style options. No. All right, so yeah, I'm gonna talk about it in our next session. Cool, no additional questions. All right, so next session we have for today is to talk in detail about the whole option exploration assignment process. Okay, and I think some of the questions will get answered. Let me go back and see, there were some other questions. Can the question from Ross, can the stock part of the covered call be the created using option? Yeah, then that becomes your synthetic. It's not a pure covered call. That becomes what's called poor man's covered call. Yeah, that's not a covered call in the true sense. Cool. All right, so no further question. Let me jump on to our next section. What happened to the chat window? Okay, let me just bring up the chat. Okay, the next one I want to talk about option exercise and assignment process. This is something which scare a lot of newbie traders. When I was getting into option trading, everyone cautioned me for all the good reasons, right? All my well-wishers told me to be careful about if you are selling options, be careful about when you get assigned. So that's what we're going to talk about. All right, why I want to talk about? Because for a new trader, option exploration and assignment is a mystery. And I can't tell you how many times, some of my friends who started discussing these options with me much sooner, earlier than when I started, doing this webinar or the boot camp, would call me and ask me, I mean, will I get assigned? The stock price has moved. It is in the money. You told in the money as as an option seller, it's not a good situation. Will I get assigned tomorrow? What's going to happen? So we're going to talk through the whole process of, when the assignment will happen. It is a mystery if you are just starting into options trading. But, once you have gone through a couple of expiration periods for a few months, if you're done, it's not a big deal anymore. Sometimes it can be a scary phenomenon because if you don't understand the whole basis of how this process works, it could scare you. The words like margin calls, etc., they originate from this process. So, and that's where a lot of people get scared. So what I want to do in this session, I will break down the entire process so that you can gain a full understanding of how everything works. And then in the end, if there are still questions, I'll be happy to address those questions. So let me sip some water and then I'll start. All righty. Why we need to talk? If you've always been a stock investor / trader, you never talked about expiration. You never talked about assignment. You have a stock, it's in a portfolio. That's it. It's there forever. Unfortunately, options have a finite lifetime. They don't stay forever. When you buy or sell an option contract, you know at that point of a time, when is it going to expire? Could it expire 7 days later? Sure, if you pick a week expiration or a month expiration, or you could pick up something what's called leaps. I don't want to get into the details of it, but those are the options that expire more than 9 months later, right? You could pick up something which expire in 2022, but it does expire. It has got a limited shelf life. So every option will expire. Just, that's how the business works. You cannot pay a premium, a limited amount of premium, and can get right for unlimited amount of time, right? So depending upon how much money you've paid and other things, you will have a right only for that amount of time. So that's why we need to talk about expiration, because they have a finite lifetime. Second thing is options are regulated by Option Clearing Corporation, OCC. This is not the other OCC, which is Office of Comptroller of Currency, which basically regulates a lot of these money services companies. But this is called Option Clearing Corporation. And so Option Clearing Corporation is the regulatory body which makes sure that the whole assignment and exercise process works. So a quick note around the exercise versus assignment. We talked about it earlier also. Just to rephrase, exercise is initiated by option buyer. Buyer has the right. So if they want, they can exercise their right. Or if they don't want, it's okay. They may not have to. Or it can be auto-initiated for in-the-money options. I'll spend a minute later on to talk about what this auto-initiation means. So if the option is in the money, it means it's a profitable situation for a buyer. Then it is in the best interest of a buyer to exercise it Even now, even more, because there are most of the brokers don't even have assignment fee. Up until late 2019, if I were to exercise or get something assigned, I used to think about how much assignment fee I have to pay. But nowadays there is no fee. So if I'm an option buyer, and if it is in the money option, it is always beneficial for me to basically exercise it. And that's why there is an auto initiation process of assignment. It is assigned to option seller. And as an option seller, if I see that any option is in the money, then there is a high chance this will be assigned to me. If it is expired in the money, there's a high chance it will get assigned to me. So as an option seller, I need to keep an eye on it because it will be assigned to me. And if it gets assigned to me, as a seller, I have an obligation to perform as per whatever the contract I sold. So if I sold a put, means I gave someone else, I gave the option buyer a right to put the shares to me. So if that contract get assigned to me, then I have to buy the shares from him. Or if I've sold a call option, a covered call we talked about, and now that option expires in the money, then I will be assigned that covered call. So when I sell a call, I give someone else a right to call the shares from me. And if that contract get assigned to me, I have to give them my shares. I cannot say no because I have an obligation. I don't have a right as an option seller. Only the option buyers have the right. Okay. So we'll look at what OCC is. OCC is the world's largest derivatives clearing house. We call it derivatives because options derive their value from stock, and that's why they are derivatives, right? Now, OCC provides services to all the exchanges where options are traded. And I was surprised to see that there are actually 19 exchanges. This is the list of all the exchanges. You got almost 16 of them are equity exchanges where equity options trade, box exchange, CBOE, one of the biggest. And then there have a flavor, CBOE BZX, CBOE C2, CBOE EDGX, etc., right? And then there are 3 exchanges on which the options on futures will be traded. CBOE futures, one Chicago, and a small exchange, which is the newest one. So there are almost 19 exchanges on which these options get traded, and OCC provides a service to all of them. Now, if you are using Thinkorswim, and that's where you can actually see, the exchanges. If you want to route your order to a particular exchange, say if I'm selling a put here, I can actually pick up. So it says exchange here. I can actually pick up which exchange do I want to route my order to. C2, BTS, NASDAQ, BOX, ISE. I don't think every platform does it, but Thinkorswim does allow you to route to order to a particular exchange. Not that I do it, for every order. I generally leave it at a best so that I leave it to TD Ameritrade to figure out the best routing logic. But if my spouse was working on a particular exchange and I was dealing in millions of contracts, maybe I will send it to a particular exchange. But something just to take note of, right? Doesn't really matter a huge amount of, when you want to send it, unless you are trying to do an arbitrage between 2 exchanges and you see it is available for a penny less at a particular exchange, or you can sell it a penny more. As a retail option traders, doesn't really matter. Okay. All right. So let's get back into it. So OCC is the world's largest derivative clearinghouse. They provide services to all the exchanges where the options are traded. Now, because It deals in equity options as well as futures options. It needs to operate under two different regulators, SEC and CFTC. SEC is Securities and Exchange Commission. They regulates everything around equity. And CFTC, Commodity and Futures Trading Commission, they regulate everything that happens in the future world. Because OCC has to provide services to both future and equity options, they need to operate under jurisdiction of both of them. OCC also act as an issuer of options and a guarantor for all the equity and future options. So the way now we trade options, I don't know who the other party is. I don't know who is buying it from me. Maybe I'm selling an option. Maybe you are buying that option. I selling a put. Maybe you buying the put. I don't know. But I do know that there is OCC, which is kind of a backstopping and providing a guarantee to me that if this option expire worthless, I'll retain all money. Or if I bought a put and I want to exercise, I will be able to exercise. So they act as a guarantor for all the options that are being traded on US exchanges. All right, so they guarantee all the trades because they act as a counterparty. So if I'm a broker house, I don't have to take the counterparty risk. Or I probably have to take those words. I have to study in terms of what's the counterparty risk as a broker. But if I am an option buyer, I have a backing of OCC. I don't have to worry about a counterparty risk. But they are not the other party. I am not trading. In the end, it's not that the OCC is buying that option and the people at OCC are making money out of it. No, they just act as a regulator that watches every option trade that goes through and make sure that both the parties on the two sides of the option trade are doing and will do what they committed in the option contract. They act as an overseer. They don't profit from, if they had bought a call and the stock goes higher, they don't profit. It's a call option buyer who would profit. But OCC will make sure that the call option seller does its part. So hence they're direct participant in every option trade, but they are not the active party on the other side. So let's look at an option expiration. When does an option expire? So most of the options that we would be dealing with as a retail and new option traders would expire on third Friday of the contract month. Because I generally recommend on picking monthly expiration, and that's what it is, the third Friday of the month. Now, the last week was the July expiration because it was the third Friday of the month. Now for August, it will be August 21st because that is the third Friday of the August month. So now, if I don't want to go through the process of assignment, because if I'm option seller, then I need to make sure that I close all my positions before expiration. And we will talk about it that you can also be assigned sooner. But in the best situation, at an expiration, if there is any position which is in the money, that will get assigned. And if I don't want to go through assignment process, I would rather close all my positions before it. Now there are some weekly options. I'm putting a disclaimer here because, like I said, as a retail option trader, I suggest to trade in on monthlies. There are different type of risk if you're trading in weeklies, but there are weekly options which expire, every Friday. Or there are midweek options in a heavily traded tickers like XPX, SPY, and other tickers, you will find that there are midweek expiration period. And then there are some weird stuff like VIX, for which you'll have some Wednesday expiration period. So let's jump on to Sim so that you can get some feel of how it actually looks like. So I don't need to see the orders. So we are looking at VIX. So now VIX has got an expiration period on 5th of August, 12th of August. What is 5th of August? 5th of August in the calendar, it is Wednesday. So VIX expires on Wednesday. So if you're trading in some instrument like VIX, it's not always Friday. Most of the equity options are Fridays. So let's look at SPX. SPX is a heavily traded ticker, right? If you look, like 838,000 tickers trades happened on SPX. That's the volume. You might say it's even less than 1 million. But remember, SPX, each contract notional value is 300. Today it is 325. So $325,000 is what the notional value of each contract is. And there are 840,000 contracts traded. So from the value, it's a huge product. Institutional investors, traders with big account, always trade in, day out, SPX. Right? For people like us, I prefer trading in SPY, which is 1/10 of SPX size. Right? It's a heavily traded ticker. 3 million contracts were traded today. And it's got, midweek expirations. It's got a weekly expirations. You see a lot more expiration period available in these heavily traded tickers as against, let's pick it up, what Palo Alto Network. Even it has got some midweek. So depending upon how liquid the tickers are, you will see a lot of expiration periods listed based on that. Let me pick up something which is not very liquid. I generally don't trade in illiquid stocks, so can't even put my head on. Let's say, how about Nikola has become very liquid nowadays. CGNX. Yeah, well, let's pick this. Cognex Corporation. Probably never heard of name. That's why it is not that heavily traded. Hardly 545 contracts today. It's got only 4 expiration period. It doesn't even have a December open yet. It doesn't have October open yet. So it's only got August 21st. It doesn't even have a July 31st. So depending on what's the interest, how heavily those options are traded, your option expiration periods could be different. Now let's talk about something called American versus European options. I know Fred already helped in that. So there was a question around, when can this be exercised? If it is an American type option, that doesn't mean that it's been issued by an American company or only the companies that operate in America, just that it is called American type option. And those options can be exercised anytime during the option period. So as long as that option is valid, option buyer can exercise their right. So it means if I'm an option seller, I can be assigned these option contract anytime throughout the options period. Means it's not that the risk of assignment is only at the end of expiration. It could be assigned anytime. Most of the options that we as a retail investors, part-time option traders, would deal with are American style options. Means the risk of assignment could be at any point of a time. European type options can only be exercised on the last day of their option period. If it is a monthly option, is third Friday of a month, or if it is a weekly, then whatever that last day it is. So they cannot be exercised before the, as an option buyer, you cannot exercise it before your expiration period. Those are called European type options. Okay, next one I'll talk about is for in the money options. We talked about auto exercise. So for in the money, OCC has a provision, and through the broker, they have a provision for auto exercise. Means any option that is in the money by more than a penny, it will be automatically exercised. So if I have bought a call option, right, at $50 strike price, and I forget about it, and that option contract is now expired. Today is Friday. An option contract expired. I didn't pay attention to it because I was in a meeting, and the stock closed at $50.02. Now that will be automatically exercised for me. Now that means I will get those shares into my account because I had bought a call option. I bought a right to get the shares, to call the shares at a strike price of 50. And now if that option expires in the money by more than a penny, it will automatically be exercised. Means come Saturday or Sunday, depending on when your broker settles it, you will see those shares at a cost of 50 in your account. And you will see $5,000 moving out of your account for one contract. So if you did not want to hold the shares, then you should have closed your option contract before expiration. Because if it is in the money, it will be auto exercised. The other way is if you don't want to go through this auto expiration process, call up your broker. Tell them, don't put me in auto expiration, the auto exercise process. Then the broker will not exercise it and it will expire, it's already expired in any case. So make sure you, even if you're an option buyer, even though the contract at that point of a time at expiration is profitable for you, if you buy a stock, you end up into owning the risk that comes with the stock. So if you don't want that risk, call up your broker and tell them you don't want to go through that auto exercise process. Or better, you close your trade before the expiration period. All right, we will now go through the whole assignment process. I talked about multiple parties, right? Option buyer, seller, we talked about OCC, we talked about brokerage houses. So now with the kind of a flow diagram, we'll try to understand how all these parties come into picture, how this overall assignment and exercise process works. So first is an exercise process. It has to be initiated by someone who is holding a long option. Could be a call or a put, I don't care. In this example, we're talking about the call option. So I'm a call holder, means I have bought a call option. Now that call option is in the money and it is, let's say, before expiration, because at expiration, these things will happen automatically. But it is in the money and I want to exercise it now. And what I need to do, I need to call my broker and say, I got this XYZ stock. I have a call option on it at a strike price of 50. I want to exercise that. And my broker will then send the request over to OCC. That's where OCC comes into picture. It's not that my broker is, doing everything. Excuse me, I'll just sip some water. So the broker will send a request to OCC and tell them, I've got a customer who's got a long call option and now he wants to exercise it. So now OCC will get that request. Now OCC will randomly select any broker from their network, any member who has sold a call option. They'll pick up anyone, any of those members, and send a request to them saying, someone from you had sold a call option. Now here's someone who wants a call option. Now basically you have to deliver onto it, right? Work with your customer who has sold a call option and get me the shares. So whoever has sold a call option, call writer's broker, will go and see. There could be hundreds, thousands, millions of customers who would have sold the same call option at the same strike price. Now, broker could randomly pick up anyone, or they may pick up, first in, first out, means whoever had sold that call option at the strike price for the same expiration period first. Maybe they'll need to perform their obligation, means sell their shares. Or they could pick up just randomly. Brokers have a different logic. And then we'll say, okay, you sold a call option. Here's now you've been assigned that call option. That means as a call option writer, I have to now sell my shares. My shares will be taken away. I gave someone else a right to call the shares from me. Now that contract is being assigned. So I have to give up my shares. So the broker takes the shares away from me, delivers it back to OCC, saying, here's the shares. Those thinking shares you asked from me, here are they, take it away. OCC routes it back to the broker from where they got the request, and broker will deliver those shares in the account of the call option buyer. So this is how the overall initiation starts from exercise and the overall assignment process works. Now, the key thing to note here is the process is very random. That's the point I want to drive home here is, number one, the OCC selects a member, firm randomly. Say I mostly trade with a TD Ameritrade. Right? Say I have sold a call option at XYZ stock at 50. You have sold a call option at XYZ, but you trade with E-Trade. And that option has yet to, the expiration period is a week away. But maybe you got assigned today. I didn't. No, since they just send it to E-Trade. They didn't send that request to TD Ameritrade. Say if you are also on TD Ameritrade, I am on TD Ameritrade. Maybe you still got assigned. I didn't, because TD Ameritrade randomly pick up whoever has sold that call option. And they only received, let's say, 100 requests for today. And they picked up 100 and assigned it to those 100 call option sellers. I wasn't one of them. So I didn't get assigned. So many times I get this question around, if I'm selling the option, is it the buyer, is it the same buyer who will be, exercising, and do I need to deliver the shares to the same buyer who bought that call option for me? No. You could have, when you sold the call option, person A could have bought that call option from you. And when you got assigned, you could have been assigned to deliver the shares, maybe to person B, as long as it's the same strike price, it's the same ticker, it is the same expiration period. These are all fungible, means one contract can be replaced by another. We really don't know who is the person who is buying from me. And the whole process is very random. So as you trade more and more, you will figure out someone, in our Slack group chat saying, I got assigned, and others like, I did not. So that's where, how it happens. It could happen that one of us get assigned, other ones couldn't. It's a very I've seen that happening very commonly. Though at an expiration, if the option expires in the money, then everyone will get assigned who had sold that option. But before that, this whole process is very random. And I've been in cases in which some of my other fellow traders got assigned, and I didn't get assigned on that exactly same option contract for for a few days, for up to a week. And then I'm like, he got assigned, maybe I could get assigned, so let me either take care of it if I don't want to basically go through assignment process. So it is a random process. It's not that everyone who's selling the same option contract will get assigned the same day. That's not how it works. All right, so let's look at a settlement. So once the assignment happens, the next step is settlement. Like I told, depending on when your broker settles the stuff, the trade or the process, you could see the delivery of the underlying equity in your account, maybe by Saturday or by Sunday. I think for me, I generally see all those trades settling on Saturday. So if I have bought a call option, okay, let me first talk about an example where, because it says sold a call option. So if you have sold a call option and it has been assigned to you and it is a physical settlement, means you have to deliver the shares. Most of the trades that we do are all physically settled, means you need to deliver the shares or you need to deliver the ETFs. If you have bought call options, then you will see that your account, you suddenly see those stock, XYZ stock appearing up. 100 shares of XYZ are now in your account. Or if you bought a put, then 100 shares of XYZ have moved out from your account. But this is called physical settlement. You have to deliver the underlying shares, or you have to buy the underlying shares, depending on what the option contract is. Now, there is a other form of settlement, which is called cash settlement. In this case, it is impossible to deliver the underlying ticker that we are trading, right? For example, SPX. SPX is not an ETF. RUT is not an ETF. NDX is not an ETF. It's just an index. It's just a number. You can't deliver a number. So these option trades on these tickers settle through the process of cash settlement. Means you won't get SPX share because there is none exist, right? There is a VIX. There is nothing there is no VIX ETF or shares. They don't exist. So you cannot be given shares, but your account balance will change to reflect what, as if you got the shares and what's the value of shares, etc. The end profit and loss will be calculated for your position and your account balance will get updated. This is called cash settlement. In this case, there is no, risk of holding the underlying, right? Because there is no underlying to be held here. Say an example. If I bought a call option on SPX at a strike price of 3,300 and I forgot about it, and now that it's beyond the expiration period, it's a Friday, I didn't take care of it. Now at expiration, SPX was trading at 3,300, 3,320. It means it is $20 in the money. Because it is cash settled, only thing that will change in my account is $2,000. because $20 per 1 unit of SPX contract has got 100 units. So it is $2,000. My account balance will increase by $2,000. That's it. There is no, coming in of SPX shares or going out of it, because none of those things exist. These are cash. This is called a cash settlement. So if you are trading in some securities, be aware, if it is cash settled or not. I would love to trade in cash settled, because then we don't have to worry about taking assignment of the stocks. But most of the equities, they're all, because they have underlying shares, they are all physically settled. These indices, they are cash settled, because there is nothing to deliver. Okay. Now let's talk about the $1 million question. When can option be exercised or assigned? Like I said, American options, which is what most of the time we will be trading in, can be exercised anytime during the options live period. So if I bought a call option, if I sold a call option and that expires on 18 September, because it's now, most of the trades I'm putting in, new trades I'm doing for September expiration. So the expiration date is 18 September, but it is very much possible that I could get assigned, I could, be assigned that contract 2 weeks from now. Though it can be exercised, but most of the time the exercise happens during the last week. In, let's say, the week from September 13th to 18th, or whatever that from that Monday is, 14th to 18th. Most of the time, that's where the exercise will happen. And the reason is because exercise is initiated by option buyer. Now, I won't dig deeper into it because we haven't yet touched the intrinsic and extrinsic value. So if you're not able to get through this, not able to understand, it's fine. But the reason is that if an option buyer exercises it sooner, they're basically giving up all the extrinsic value, all the value that is still in the contract, because there is still a lot of time available to expire. So until the extrinsic value is really small, there's little chance that your option will get exercised. Now, there are cases wherein even if the extrinsic value is 50 cents, it's not small, you could still get exercised. I'll talk about that after we've gone through extrinsic and intrinsic value and how to find it and how to know when my option trade could be at a risk of early assignment. Okay. I'll cover it in a separate topic, because before that we need to understand the intrinsic and extrinsic value, how to find it on the broker platform. That will give us an insight into, am I at risk of early assignment or not? But in theory, everyone who has sold an option, and American type option, is in theory at a risk of early assignment. But will that risk materialize? That depends upon the extrinsic value. Okay. Next one, if you get assigned, what to do? I didn't take care of my options. I didn't close it. I didn't call up my broker to not take me through auto assigned process. And now I got assigned. So yeah, I sold a put. Now I got assigned means I got a shares in my account. On Saturday, I'm looking at it. I'm like, what happened? Where those $5,000 went away? And then I realized those $5,000 moved away from my account because I bought 100 shares of XYZ at a $50 strike price. Now I have to take a decision. If my portfolio can handle it, and if I want to keep XYZ shares, then I would like to hold the position. Then come Monday, I'm like, fine, $5,000 XYZ stock. I think it's okay. $50 on XYZ, I think that's a price at which I'm okay to hold it. And the reason I'm bringing a portfolio is that's not even 5% of my portfolio. So it's fine. It's not a too big a position for my portfolio. By the way, if it is too big, then basically I shouldn't have even done the trade to begin with, right? So, but just in case, I want to look at more from a portfolio perspective. Maybe do I already have its brothers and sisters? Do I have ZYX, XZY? Essentially the stocks in the same sector. Am I getting overexposed to this sector or not? We go through all this decision making at a portfolio level, and then decide, is it okay for me to hold the position? If it is okay, fine. I'll keep the position. I'll have the stock. And then I can decide how I can, reduce the risk further. So if I bought a stock, maybe I can think, okay, I'll sell covered call. Get some premium, reduce cost basis. We talked about covered call in drill 2. Right? What to do with the stocks that are in your portfolio. They are lying there. It is a risk because stock could go down to zero. Even though I'm bullish, stock doesn't care what I'm thinking about it. So then I evaluate if I want to implement, risk reduction strategies or not. Right? If you're in our Slack group, you would have noticed today I shared some trade on ServiceNow, and I specifically mentioned, if I get assigned this, fine, I'll start doing covered call, because I think on a long term, based on the analysis that we did on a ServiceNow on last Saturday, I was bullish on it. Looks to be a good company. But then who knows in a short term where it will go? And looks like after the results, and it actually went down. I'm fine. I already know that if it goes down, I'll basically sell covered call. And my portfolio is okay to hold that position. So go through this decision-making process. Don't otherwise, don't get into panic. Well, what am I supposed to do? Just think through these steps before, that if you get assigned, you're going to do A, you're going to do B, you're going to do C. And then if you forget, if you get assigned, you already have mapped out exactly what you're going to do. And if your portfolio can't hold the position, then come Monday, get out, sell it. Now, depending on where it is trading on Monday, XYZ could be trading on 52. You were lucky, you got it at 50. Now you can sell it at 52. Or it could go down to 48, hard luck. You should have looked at your positions and should have understood that if you get assigned, you are bearing the risk of holding the stock. And if you were not okay to bear the risk, you should have closed your position, before the expiration period. So, but if your portfolio can't hold it, then close out your position. So if you sold a put and you now receive the stock, you sell the stock back. Or if you had, and I don't want to talk about the naked call. Okay, so let's leave that example out. So, but if you sold a covered call, say, and that shares got called away from you, but you still want to have those shares in a portfolio, buy it back from market. Yeah, take the decision on what you want to do, but do all these decisions, have it mapped out in your mind. Maybe once you're starting with, write it down on a piece of paper, put it on a post-it, take a note on post-it and stick it on your monitor saying, XYZ, I sold an option. This is what I'm going to do if I get assigned. And slowly, it'll become muscle memory. Then you'll start to look at your portfolio and say, nothing to worry about, or, I'll close it before. But if you're just starting off, write down what you're going to do so that you don't get into the panic situations. Because if your portfolio can't hold it, and if you don't take an action, you will receive what is called a dreaded margin call. And this is what scare most of the new option trader from options trading. They have heard horror stories of margin calls from their friends, from their relatives, and have been cautioned time and again. Options are risky, don't deal with it. But if you have gone through the process that we talked about, and if you have taken those decisions that we talked about, you will never receive a margin call. Either you close your position or you do whatever you want to do. Just from an education opinion, in my years of trading, I have never received a margin call. So when this market fell down on March 23rd, my portfolio, it was still okay. But I thought, what if it falls down another 20%? It already fell 30%. So I wanted to understand how the process worked. So I reached out to another fellow trader. I'm like, do they really call you or they'll send an email? Because the name says margin call. I'm like, will I receive SMS or will they send me an email? What do I need to keep an eye on in case overnight market falls by 20% and 30% and then I'm at a risk? And I was told that they will actually call you. I'm like, okay, I need to make sure that the TD Ameritrade number, I put it in my contact list so that I see it's coming from TD Ameritrade and don't ignore the call. If I'm not sitting in front of my laptop and if TD Ameritrade calls me for a margin call. But fortunately, nothing of that sort happened. But they do actually call you. They will give you a call. Most of the brokers, and this is all theory, what I learned by talking to other traders, because I didn't have to go through the whole process. I never gone through it. But most of the brokers will provide you some time to come up with the funds, right? Let me give you an example of what a margin call could be. Say your portfolio is, you have only $10,000 in your portfolio. And you are on a margin account. First of all, you end up into this position only if you have a margin enabled, which is a great thing. I mean, I have a portfolio margin enabled. But if you don't take care of some of the steps we talked about, you end up into this margin call situation. So say you have a $10,000 account with margin on it. And now you have sold put on SPY. Right? SPY is trading at $325. That put get assigned to you. You don't have that amount of money in your account. Right? Now, broker will call you, say, add the funds in your portfolio, and they'll give you some time. What I've been told is you get 24 hours on TD Ameritrade. So please check with the TD Ameritrade as well as with your broker in terms of how much time will you get to come up with funds. Because I want to be very frank and upfront. I have not gone through the process. It's not a first-hand experience I'm talking about. But what I heard is TD Ameritrade gives you 24 hours. So if you get assigned on Friday, then at expiration, you have a time till Monday end of a day to come up with the funds. But check with your broker, because if you don't, then broker will figure out and sell the positions, right? Say you had $10,000 cash, but you had some other stocks. Broker will pick up and sell the stocks, your stocks. Now you may not want to sell the stocks. Those were, you recently bought it. Now you have to pay the tax if there was, you had a short-term capital gains on it. Maybe those stocks you wanted to hold for long. Why would you want to have a broker take a decision on your behalf? But if you don't come up with the funds, broker will take a decision on their behalf. They will liquidate some of your positions to raise the funds. They're not going to take the risk on their books. They will make sure that they can get their hands into the funds from all the positions that you hold. So first, the best thing is not even get into this whole process, right? If you have an options that you think could be at a risk of assignment, close it. Close it before, going through an expiration period. Or If you are okay to go through expiration period, maybe, I want to buy SPY at 323, make sure you add additional funds. Otherwise, it's not a good situation. Broker firms don't have a fiduciary responsibility. They are not your financial consultants. So they will sell the stocks whichever they want to tell, whichever they want to sell. They are not going to look at the tax law and do the things which is best from a tax perspective. Nope. They will sell. So check with your broker how much time you may get if you have to, if you get a margin call. I would say best is never get into the process of margin call. And if you follow and, basically live within the guidelines and the guardrails that we will talk about throughout this boot camp, hopefully you'll never get into the process of margin call. Even though you may be on a margin account, not even a regular margin account, but on a portfolio margin account. I pay only 1/6 because I'm on a portfolio margin account. But still, we just want to we have to make sure that we look at the rest of the things in portfolio so that we are not at a risk of a margin call. So that would be the best situation. Never get into that position. All right, that brings us to the end of today's the second session, which is all around the option exercise, assignment, margin calls, and how we can and why we should avoid it. Let me go back to some of the questions. Okay, we got 20 minutes. I finished sooner than what I expected. Most of the days I will just run over. So I wanted to be really cognizant of the time. I know many folks are from East Coast and it's gonna be already 10:40 p.m. We're good that we're finishing in time today. So let me look at some of the questions. Can assignment happen anytime or only expiration? Raghu, that we already addressed. How can you tell how many contracts were sold? I think this is from when I said this is the volume. So what I look at is it's a total volume. I don't know if it's a buy or sell. It says puts 115, calls 430. So total volume traded is 545. So let's look at SPY. People can guess, can make an intelligent guess on whether it is a buy or a sell. For example, this is 3 million contracts total traded. 1.8 million were puts, 1.2 million were calls. Now, looking at how many were traded at a bid or below, you may be able to see, whether those were desperate buys or sells. I really don't focus much on these because this may be a short-term decision that you may want to take. As a part-time option trader, I never had a need to look at whether, there are more puts are being sold or, put call ratio. What's the put call ratio for today? What's the put call ratio for yesterday? Those don't really apply in my decision-making factor if I am looking for a trade. But I hope that answers the questions on where do I see. So if you're on think or swim, pick up the ticker, come down all the way down below the expiration periods, below the option chain, and look at today's option statistics. They'll give you some nice, good information. How many were traded between what deltas, etc., etc. Do they charge interest on margin calls? Yes, they do. Nothing comes free here. Yeah, 8 to 9% in TD trade. Yeah, interactive brokers, I'd see they charge less. Okay. Cool. Other thing is now sometimes the margin is not only in this margin call. For example, sometimes if you are selling a call, again, As a newbie option trader, never sell a naked call. But as you graduate further in your trading, you would start to do, let's say you are selling a strangle, which means selling a put and selling a call. In case if you are selling a calls on a stock that is really hard to borrow in the market, in that case also you might be hit by something called a margin, because then your broker will have to pay money to borrow the stock for you because you've sold it. You don't own the stock. So there's another concept wherein there's a margin money involved. But let's take that maybe for a later sessions. But in this case, yeah, if broker adds up fund into your account, you basically have to pay the margin interest. Cool. All right, like I said, that brings us to the end of my stated agenda here, but we still have some time. And now I'll open the floor for any other type of questions, either on drill number 1, drill number 2, or what we have discussed today. And I mean, I can also open if you want to ask that question, just let me know and I'll unmute you. Cool, all good. By the way, today I spent a few hours in listening to the whole tech CEO's testimony in front of judiciary subcommittee. Really interesting. Was really interesting. Now, where the NASDAQ will go tomorrow, nobody knows. But from both sides of aisle, I could see at least all the members of the subcommittee, they were really scathing remarks on what's happening in the tech industry and the monopoly that they have. So I talked about Slack group. I don't know if all of you already know about it or not, but this is what we have. Let me just see. Yeah, we got maybe around 98 members. So I will share the information or put it in the chat. If you want to be a part of this, you're welcome to join this group. Because in a session, we only talk on Wednesdays and Saturday. Wednesday is our boot camp where we only talk about, a lot of these theory around options. Saturday is where we talk about the stocks and trades and, analysis of a company or a pre-IPO company or something which is brand new in the market. And we as an investor should look into it, like SPACs. How does a SPAC work? How does a blank check company work? What are the pitfalls that we need to be aware of? We all those things we talk in our Saturday sessions. And both in the meetup, I add those sessions. So if you're interested, you may join up the Saturday session as well. Okay, let me share the Slack chat. And if nothing else, I think then we'll call it a day here. Come on, where's the chat window? Okay, let me. All right, a question. Oh, can you walk through a scenario of closing a trade, specifically on criteria and rationale for deciding the exit? Sure. Santosh, missed first class and access to the class video. I haven't yet figured out on that one. So if you're on Slack, I share the deck. So Santosh, just join the Slack and ping me on the Slack group. Or if you go to the education channel in the Slack group, you will see I have shared the deck of the previous ones. Yeah, because the question from Ramesh, Raghu, I'll come to yours again. Is the info only via Slack? Yeah, because I found that's the most comfortable way for me to interact, because I can categorize all the discussions in Slack. Unfortunately, I had earlier tried, WhatsApp and Telegram. Just doesn't really, it's not that productive. Slack, we can actually put everything, well categorized. So for example, I shared the Saturday deck here, some market news, anything random. Someone has a trade ideas, we'll use here, we'll share some trades here. Rana, oh, I didn't see him. Okay, Rana made good one on Kodak. So yep, I'm a fan of Slack, and I stay more active on Slack than anything else. All right, so question. All right, so now let's say closing one. Right, I talked about it on Saturday, but let me take an example of which one? JP Morgan trade. All right. So first, I have a kind of a trade exit point. I already keep that in my mind for a different type of option strategies. So if I am selling a strangle, then my target is around 60% of what maximum I can ever get. Let me take an example of a spread, because you may not be even, if you're a new option trader, you may not be even allowed to do a strangle. Okay, let's take an example of this. This is a put spread on Visa. I sold a put spread on Visa, right? The maximum profit that I can make in this is $260. I sold 2 contracts, collected $1.30 as a premium per contract. Right? So if you go back here, look at Visa, this was my trade. I put this contract on 24th, $1.30, 2 contract, maximum I can make is 260, which is what Thinkorswim beautifully shows it here at the bottom, right? Now, if it is 260, I want to exit this trade when I'm making, around 60% of 260, whatever that math is. So means 50% is $130. So generally what I do is I will put a GTC closing order. So probably I should already have it for this one. Let's go back and look at all the working orders. See, I already have a GTC closing order. So if I were to close it at a 50%, that would be 65 cents. So I'm like, to buy it back at 65 cents, right? Because I sold it at 130, 50% of 130 is 65 cents. Like I said, I generally want maybe around 60% of the maximum. First thing I go and do is the moment my trade get executed, I immediately put a good to closing order. So I put a good to closing order for 50 cents. Right now, if Visa goes high or the theta decay happens, I don't have to sit and watch this trade. Whenever it hit my profit target, I'm out. I'm automatically out because this order will get executed. So, but if this order doesn't get executed, let's say Visa starts to fall and I want to, get out sooner, then I will come back and say, I'll change it here. I'm like, you know what? Let me take a little more debit and I'm okay to make less money. I'll modify the order and then send it. So for each of the option trading strategy, and we'll talk about in subsequent sessions, what are the general profit targets that we could keep. So one is if the stock hit the profit target, I'm out. The other thing is also is, how much is the duration left for expiration? Because as you get closer and closer to expiration, you start to increase the risk in your trade. I don't want to introduce the Greeks right now, but there's something called gamma risk. That's all you hear about Greeks today, gamma. Later we'll talk about the details. So based on these are the two deciding factors on which I will decide and exit the trade. Do you set an alert for a stock price? Not really, not the most of the time. I won't have an alert for a stock price. What I could have, because this is a defined risk position, if it goes down, I know what my risk is. So I wouldn't set an alert to notify me, that, I don't know, should I set an alert for here? First of all, I don't even know where should I set an alert. Should I set it for here? Should I set it for here? Because this is a defined risk position and I only know what is my maximum risk and I'm okay to take it. I won't set an alert. However, if you are and if you are a fan of stop loss, which I am not, because stop loss actually really doesn't work, especially around on options trading, because they will take you out of the trade while the trade could still make profit for you, because there's something called probability of touch, which is higher than the probability where the stock could be at expiration. And if you put a stop loss and there's a double probability that a stock will touch that price, you will be priced out. Whereas you could have, if you had stayed it, you would have made money near expiration. But if you are a fan of stop loss, then maybe you want to put a trade alert saying, okay, tell me when the trade hits that price. What I do put an alert is so that I don't forget if a stock or if if there is an earnings coming up on Visa. So I will look at it and look at some of my positions, which I want to get out before the earnings, or I want to be aware that I need to take care of earnings. There I'll put some, alerts. And recently I actually did that. Let's say, where do you see where's my analysis, the whole alert book. Oops, there was alert. So, right, here's my alert book. For example, CGNX is having conference. Just send me announcement before it. Earnings event for Aichi, because I have a positions in Aichi. Earnings, I have something I set on Lulu because this is not for option trade, but from a stock perspective, I had sold Lulu earlier at higher than 310, and I thought if it will come back, I'll just buy another 10 stock. But for options, most of the time I'll have earnings event because I have a put spread on Paycom. So things like that. Sometimes if I want to buy, if I have a thought process that if a stock falls below 20 and I want to go bullish, I'll go ahead and set an alert, but I generally didn't see the need for it. How do I monitor stock is going down? I don't have to monitor on day-to-day basis. If I have a need to monitor on day-to-day basis, then I would rather look at what am I doing wrong here? Why I need to panic here? Either my position is not risk defined, or I've taken up too much delta, so too much risk. So I don't have to monitor day-to-day basis. Question from searching. Can you set option price alert as well? Yes. I've never done that, but I've seen many traders doing that. So for example, I think, let's say we talked about, let me open up. This is an interesting discussion because it's the first time for me also. Let's figure out how that works. But I think I've seen someone doing, let's say create alert. So this will actually create an alert for me. Right? If you are not a fan of GTC order, you can actually create an alert saying when this put spread is trading for this particular price, you alert me. Or if you're okay to buy it at a certain price, then what I'll do is maybe create opposite order and maybe put an alert on it. Hopefully I can create alert. Yes. Oh, this says buy alert. Okay. Change. Okay, so maybe you need to I don't know how exactly, but you can put it. So let's see if I, in an account statement, can I go ahead and create? No, so you can put an alert if I want to monitor the position for, let's say, on my working orders. Yeah, there are conditional orders, and you can go all crazy on toss. It is very, very powerful. I haven't even explored, I would say 10% of it. Oh, this is a downloadable platform. Talks has recently come up with a web version. I got an email today or yesterday saying think or swim. We have a web version of it. I logged into it today. I really didn't like it. After using the desktop version, I've become so comfortable with the desktop version that I really didn't like the web version of it. But TOS is really powerful. I mean, it's only, I think for one of the session, I explored the think back feature to see how the option positions would have changed. But I haven't really done, OCO alerts or blast all alerts. There are multiple type of alerts that you can send it. One trigger all, one triggers OCO. Yeah, you can go crazy on it. So yeah, I didn't have that much time to look into everything, how exactly that works. Maybe someday we'll be able to spend that much time. But till now, not necessarily, didn't have that big a need. All right, any other questions? We got a couple of minutes. Okay, let me start. Cool, all good. Nothing else? Anything? Does Slack send notifications when you add something? So it depends upon, you can control the notifications on how you want to get notified. Do you want to get notified for every message? Do you want to get notified only if some message is addressed to you? Do you want to get notified if it is being addressed to like every member? Because some of the time, we really don't want to ping everyone, right? Everyone has got busy stuff. They got things to do. So if I'm just sharing a trade, I don't have to ping everyone. But if someone has specifically asked me a question, say, I think someone had asked me on the trades, then I will specifically, tag them. For example, Richard. So Kunal had tagged Richard saying, hey, I copied yours. So I tagged Kunal. So then Kunal, if he had got notification enabled on his Slack, and you can use Slack on mobile, it's a great application, or on desktop, either way, you will see that notification appearing. So you can control what kind of notifications you want. How to find the right strike price for placing a naked put? What are the indicators you use to place that strike? So I'll cover next session will be the criteria for placing a trade. So strike price comes to me at much, later in the game. There are a lot of other criteria that I go through it before I talk about strike price. So I'll go through all the criteria that, I run through in my mind before, finalizing a trade. And believe me, I had that put in a post-it note and had stuck it on my big monitor when I was starting options trading, because there is a sequence in which we go through it. Because remember, the trade is not just a trade in isolation. It's a part of your overall portfolio. And that's where I see most of the people making mistake, is looking at a trade in isolation. So we'll go through it in our next drill on what's the criteria you should run through before you open your option trade. So just wait until then. Cool. All right, we are just over time. Thank you everyone for participating today. I hope to see most of you, if not all, on Saturday session, and that will be the right place where we can talk about trades. We'll review some of the trades that we have been following and answer a lot more questions. Thank you to all the folks on the East Coast, And thank you. Good night. And the folks on the West Coast and the mid, time for dinner, etc. Do you use unusual option volume to trade? I tried a few times. You know, I was CNBC, unusual option activity. It's a coin toss. Believe me, it's a coin toss. Some one or twice it works, other times it didn't work. So no, that's not a major factor for me to find out my, to pick up a trade, to pick up a ticker to trade. I tried it, 50-50 chance, coin toss. No, I really don't have, I couldn't find that there is an edge that exists there. So then I won't do it. Cool. All right, let's end this session right here. I'll see you on Saturday. And then on next Wednesday, I'll update the meetup with the agenda and create the meetings for the next one. Cool. Goodbye.